The market is currently closed. As of the final bell on Friday, November 21st, Plug Power stock closed at exactly $1.98, marking a daily increase of roughly 4.7% despite a turbulent week where shares saw significant volatility. If you are watching this pre-market or over the weekend, note that this closing figure sets the stage for what looks to be a critical testing ground for the stock in the coming sessions. Expectation often dictates that when a company announces a massive convertible note offering, diluting existing shareholders, the stock should plummet and stay down. The reality we witnessed this past Friday contradicts that simple narrative. While the stock did initially stumble earlier in the week on news of the $431.25 million convertible debt offering, it staged a recovery by the close of the week. This tension between the fear of dilution and the relief of secured liquidity is exactly where the opportunity and the danger lies for anyone looking at this equity. Most retail traders, perhaps using Robinhood stock trading on their phone during a lunch break, might see the headline "debt offering" and immediately hit sell. But the institutional reaction suggests a different calculation is being made, that Plug Power has bought itself enough runway to survive the immediate cash burn crisis, even if it costs them a piece of the equity pie to do it. To understand why this price action is happening, we have to look at the sheer scale of the capital involved. Plug raised over $431 million. This is not a small safety net. It is a war chest designed to address the $674 million negative free cash flow the company has posted over the last 12 months. When you compare this burn rate to the early days of Tesla stock, you see a similar pattern of extreme capital intensity preceding any semblance of profitability. The difference, however, is the macroeconomic environment. Tesla grew in a low-interest rate world. Plug is fighting for oxygen in a higher-rate environment where the cost of capital is punishing. Investors using Interactive Brokers trading screens or analyzing the depth of market on the Interactive Brokers platform would have noticed the heavy volume on Friday, over 111 million shares traded. This volume indicates a massive transfer of ownership, likely from weak hands who fear bankruptcy to speculative capital betting on a survival turnaround. Let's strip away the hype and look at the actual business operations, because that is what ultimately backs the ticker. The company's Georgia plant recently recorded its best production month, churning out 324 metric tons of liquid hydrogen. This sounds impressive until you juxtapose it against the global demand and the company's own ambitious targets. The expectation from the green energy crowd is that hydrogen will replace fossil fuels overnight. The reality is that building the infrastructure to do so is agonizingly slow and expensive. The fact that they are producing 324 tons is a technical victory, proving their PEM, proton membrane electrolyzer technology, works at scale. But financially, they are selling that dollar for 80 cents in many segments of their business. This negative gross margin profile is the single biggest weight around the stock's neck. When you look at Nvidia stock or Apple stock, you're looking at companies with fortress balance sheets and massive margins. Plug Power is the antithesis of that safety. It is a pure growth play that has morphed into a distress play. If you are managing your own portfolio, perhaps through self-investing on a Fidelity mobile app, you have to ask yourself if you are buying a technology company or a financing scheme. The recent move to refinance their 2026 notes and pay off the 15% secured debentures was a tactical masterstroke by management to clear the deck of imminent debt walls, but it kicks the can down the road rather than solving the underlying profitability issue. The hydrogen economy is often touted as the next big thing, similar to how the internet was viewed in the late 90s. But just like that period, many companies will not make it. Plug Power has been around for decades, yet it still struggles to print a profit. This historical context is vital. When you use online investing tools or seek investment help from Fidelity Wealth Management, the advisors will often warn against story stocks that lack earnings. Plug is the ultimate story stock. The story is beautiful. A world powered by clean hydrogen, with Plug at the center supplying everything from the electrolyzers that make the fuel to the fuel cells that consume it. The Fidelity mutual funds that hold Plug are betting on this ecosystem, locking in customers like Amazon and Walmart for the long haul. And indeed, Plug has deployed over 72,000 fuel cell systems. That is a tangible physical footprint that competitors like Fuel Cell Energy or Bloom Energy struggle to match in the material handling space. However, the stock's technicals paint a picture of a battleground. Support seems to be forming around the $1.70 to $1.80 level. This is the line in the sand where value buyers step in. Resistance is heavy at $2.25 and even stronger at $2.50. If you are using the Robinhood app or SoFi Active Investing to swing trade, these are your levels. A break below $1.70 could open the trapdoor to the 52-week lows near $0.69, a terrifying prospect for long-term holders. Conversely, a breakout above $2.25 on high volume could signal a short squeeze given the high short interest in the stock. We must also consider the role of the Department of Energy. The conditional commitment for a massive loan is the sword of Damocles hanging over the bear case. If that loan is finalized, it acts as a government seal of approval and a low-cost capital lifeline that could send the stock soaring. If it falls through or is delayed indefinitely, the recent $431 million raise will burn up faster than investors expect. This binary outcome makes Plug behave more like a biotech stock waiting for FDA approval than an industrial equipment manufacturer. Speaking of holding through volatility, I want to hear from you. Comment below how many shares of Plug Power you currently hold and what your average buy-in price is. Are you down 50%? Are you green from buying the recent dip? Let's get a real census of retail sentiment in the comments. Analyzing the institutional landscape, we see giants like Vanguard and BlackRock maintaining significant positions, likely through their passive index funds, but active management is shying away. You won't find Plug as a top holding in conservative Fidelity IRAs or risk-averse Schwab Intelligent portfolios. It's too volatile. It belongs in the speculative bucket of a portfolio, the 5% you are willing to lose completely. Fidelity Investments often categorize such stocks as aggressive growth, which is a polite way of saying high risk of total capital loss. The recent quarterly results highlighted a mixed bag. Revenue missed expectations, coming in at $177 million versus the $187 million forecast. However, the loss per share was slightly better than feared. This less bad than expected dynamic often puts a floor under a falling stock. It suggests that the worst-case scenarios, total collapse or immediate insolvency, are being priced out, replaced by a muddle-through scenario. For those using SoFi stocks or SoFi ETFs to gain exposure to the sector, this nuance is critical. The market punishes uncertainty more than bad news. Now that the convertible note terms are known and the dilution is quantified, the uncertainty has decreased even if the share count has increased. Let's talk about the competition. The hydrogen sector is crowded with players like Ballard Power Systems and Bloom Energy. Bloom has focused more on solid oxide fuel cells for stationary power, a different niche than Plug's PEM focus for mobility and material handling. This differentiation is key. Plug is betting that logistics, forklifts, trucks, vans will be the first domino to fall in the hydrogen transition. If they are wrong and batteries win that war completely, Plug's addressable market shrinks to just industrial chemicals and heavy-duty stationary power. Robinhood crypto traders might be used to binary bets, but for equity investors, this technological risk is substantial. The Robinhood cash management users who park cash waiting for a dip need to realize that Plug is not a buy-the-dip-and-sleep stock. It requires active monitoring. The interactive broker's fee structure favors active traders who can scale in and out. And for Plug, that is the appropriate strategy. Holding this stock requires an iron stomach and a constant eye on the newsfeed for announcements regarding the Georgia, Tennessee, and Louisiana plants. The company claims a total production capacity of 40 tons per day across these sites. Verifying this production uptime is difficult for the average retail investor, but it's the primary KPI. key performance indicator that matters right now. If they can produce hydrogen cheaper than they sell it, the business model flips from cash burning to cash printing. They are not there yet. Furthermore, the macro environment regarding interest rates is the invisible hand guiding this stock. Growth stocks with distant cash flows are long-duration assets. When rates rise, their present value falls. If the Federal Reserve cuts rates aggressively in 2026, Plug Power could be a primary beneficiary, not because their business improved, but because the discount rate applied to their future dreams got lower. This is why you often see Plug move in tandem with Tesla stock or other high-growth tech names on macro news days. It's a liquidity proxy. If you are using invest online platforms or browsing investing sites looking for the next multi-bagger, you've probably encountered the hydrogen hub narrative. The U.S. government